Joining us right now is Anthony Chouinard at Mackenzie Investments. Anthony, it's a real pleasure to have a chance to talk to you today.
Thank you, Pierre. Appreciate it.
Now, Anthony, you spend a lot of time in advisor-facing conversations. You're spending a lot of your time helping advisors to figure out a way forward, given the cycle that we're in. What's one of the most common conversations you're having with advisors today in lieu of the portfolio construction question?
Yeah, I think, Pierre, it's about the evolution of portfolio construction, right? And the evolution of our business, ultimately. Because if you think of where we've come from in our business, it's been about the value proposition of security selection or manager selection and outperformance of, call it a benchmark. And I think what's happening more and more in advisors' businesses is that their value proposition is moving away from that. It's moving into wealth planning and investment planning, estate planning, insurance planning, all sorts of other aspects of creating a good financial plan. And one key element of that is really asset allocation. Right? And when you think of asset allocation, it's about how can you build efficient, diversified portfolios? Where can you generate alpha? Where should you utilize beta as an exposure, security selection, et cetera? So what I notice on a day-to-day basis is the lack of implementation of, call it, the overall beta of a market. You know, many of the advisors that I meet with traditionally have their own Canadian securities. They all tend to buy the same 15, 20 names.
Right.
They maybe use an active manager in international or global markets or specific niches of the equity markets. And then most of them tend to use active management in fixed income. So that's traditionally how a portfolio tends to be built. My conversation is just understanding where you may be having some gaps, right? And those gaps tend to be coming in my conversations around exposure to the market, to the pure risk premium of an asset class. Because ultimately, every type of strategy makes sense at a different point in the cycle, right? If you're at the bottom of a bull market, you want beta exposure, you want to ride that wave up, and you want to, perform like the market at the lowest cost possible. If you're later stages in that market, you probably want more active management or more smart beta or quantitative factor exposure.
Right.
The problem is always understanding where we are in that cycle, right? No one can accurately guess or educationally guess where we are in that cycle. We've been debating if we're at the end of this cycle since 2013.
Yeah, and then this morning you wake up and there's all these new tailwinds happening.
You got it.
Right, with China and everything's
Trade
back
deal.
on track, and we're going to make some deals, and now everything's hunky dory, and interest rates are three cuts lower.
You got it, right, Pierre. It's so hard to know. And what I'm seeing the better, those advisors who are evolving really appreciate is, okay, I can pick my own 15, 20 names, but I know that in some of those 20 names, I may have a couple of bad ones, right? Yeah. Or I'm not sure on every single name I have out there. So what I need to do is just add an element, one more position, right? Own 21 positions instead of 20, that is 5-10% beta, just the exposure to the asset class. Because at the end of the day, we do what we do for one reason. We believe that there's a premium to be had over cash, right? We believe there's a premium in equities, bonds, alternatives, whatever it is that you do, because we'd either be just holding cash at the end of the day. So because of that, if you think of beta or passive ETFs, that is that pure risk premium, right? And that does do well over time. It doesn't generate alpha, but it generates returns. And that's where I'm having more and more conversations. It's around implementing that part of your portfolio. Now, you can use factor, and we can talk about overall.
I think what's interesting about that, to me at least, I don't know, I think it might be interesting in general, is that for a very long time, arguments have been made academically, but via the ETF market, for that favored just buying an index, just buying beta, just buying the S&P 500 or the TSX, or for those arguments that are generally, SPIVA arguments that are consistently made.
Right.
Very hard, very difficult. The academic arguments are always just enough to confuse you enough to fall into the passive camp and say, I'm going to just do that.
Yeah.
But in reality, it's not happening, is it? Advisors have not actively. If what you're saying is one of your long-standing conversations, advisors haven't really been doing that, have they? They haven't been buying beta.
No.
They know about it. They read about it. It's constantly in front of them, but they haven't invested, or they underinvested in beta, or not at all.
Yeah, I think
because buying 15 or 20 stocks represents an alpha opportunity that, at least in their mind, at least in their opinion and their research.
At the end of the day, Pierre, we don't always do what theory tells us is the best thing to do. For example, many of us own homes, and we probably know that we should rent homes, right? I mean, I say that maybe in an Ontario-centric kind of conversation, but I tell you that because, the academics behind it may tell you that passive is the only thing you should own, but also what you don't take in consideration there is emotion, right? And risk aversity of a human being, right? You don't take psychology, I guess, into perspective when you're saying you're better off buying passive all the time. It is most likely true in many asset classes, especially efficient markets like U.S. large cap, maybe Canadian large cap, Canadian aggregate bond, but it's still an element that emotions don't get involved in.
I get the sense from what you're saying that most people don't feel that way.
At the end of the day, in my opinion, if you don't have exposure to beta, you're missing out on an opportunity for your business to be more cost competitive, to be more performance competitive, to be more relevant to clients, to help you generate more clients and assets, because it is an aspect of the marketplace that provides you with more efficiency in your portfolio. The reason we haven't maybe gone there is it's an internal conflict, right? It's an internal bias, an anchored bias of what we know of the industry.
I mean, maybe it's a kind of a rebellion. Like I know you're telling me this. I'm constantly being fed this opinion and this research and this evidence, but I just don't want to do it.
Well, it also comes from what the value proposition is.
Or I think I can do better.
Investor.
I think we can do better with this basket here.
Yeah, marketing goes a long way.
Yeah.
And I say that facetiously. Listen, at the end of the day, you need it all. And what I'm seeing every day is that they don't have it all. They only make bets. They only choose.
So they're not as well diversified as they should be.
If you want to build a better portfolio, you need to be more diversified in styles, strategies, factors, securities, sectors, whatever. You need more diversification. What I see is that we may believe active is, but all we do is active. So at the end of the day, it's just about implementing another layer of diversification that allows you to be, again, relevant, cost competitive, performance competitive, etc. And it's not all about beta. Listen, I believe in active management as well. You got to choose high active share managers, you got high conviction managers, those who don't look like an index, who can actually try to generate more than an index can generate. But those are far and few between, right?
Yeah.
Like we know the SPIVA report. I'm not saying manager.
Contrary to SPIVA reports, there are managers who do consistently outperform the market over longer periods of time, not year over year maybe, but over 3, 5, 10-year periods, they're definitely outperforming. All you have to do is look at the charts.
Yeah, and at the end of the day, it's, I guess the reasoning behind the SPIVA report that I get is, yes, there are some, but there are more that don't.
Yeah.
So if you think of probability, that's kind of how my mind works. Like the probability of you picking the manager who outperforms for the next 10 years or 15 years is a small probability, versus the probability of you just buying the markets that essentially do generate returns over time is a higher probability.
Yeah.
So if you're not betting, if you have 0 bets on the high probability versus 100% bet on the low probability, you probably end up having an opportunity.
Even so, we were talking earlier, and the bottom line is that if you own a decent fund, whether or not it outperforms the market is irrelevant. What really matters in the long run is that you owned it for the long run, and you didn't trade it, and you didn't make any behavioral mistakes. Because what we were saying in the discussion we were having earlier, as soon as you make one mistake, as soon as you make one behavioral mistake, like getting out of the market in the end of 2018, in a panic, good luck, as to when you got back in after you exited at the end of last year.
Yep.
And I'm just using the most recent situation that could have arisen.
Yeah.
If you missed out on 20% of the recovery, a 20% recovery which happened in the first quarter, you'll never get that back. And that 20% compared to the cost compressed solutions that are out there makes the cost compression
worthless.
It makes it irrelevant.
Yeah.
That's a 15, like
if you were superhuman and didn't have any emotion, you should only buy passive, basically equity.
But that's not reality. That's just theory, right?
So yeah, that's where I'm going with that.
But that's the point is that the worth of an advisor is to prevent you from making that critical error.
Yeah, and I say this in my presentations every day.
Yeah.
The one thing I'm certain about this industry is that the advisor's value proposition and service will always be needed.
Yeah, it's actually, in fact, it's more critical than ever, more important than ever.
But we can't have advisors not adapt to what the market is telling us.
Yeah, so we got to help them.
Got to help them.
Help
and that's where this conversation of ETFs and in general, not just passive ETFs. Like we got active ETFs, we have smart beta ETFs. I talk about all of them. But the one, again, to reiterate, the one part where I see missing opportunity is in adapting beta in their portfolio construction. Everyone's got active, right?
Yeah.
They're active or they're choosing active. Not everyone has smart beta or call it passive or traditional indexing. That's where most of my conversations go. It's about you don't have it, it is good for you, you should add it. No matter what the timing is, you're never going to get the timing right. We know that. That's an industry conversation. Right. So anyway, that's kind of really where my conversations go on a daily basis. And the ETF vehicle, obviously, being an efficient way to gain access to those types of exposure.
Anthony, thank you so much for your time.
Thanks,
it's been
Pierre.
a pleasure talking to you.
Appreciate the opportunity. Thank you.
Thank you.